Welcome to LaTour Retirement Talk. I'm your co-host, Tony Shore. And the reason I am so excited today is that I am joined by the hosts of the program, the one, the only Jim Margraf, and the one and only Josh LaTour. Jim and Josh, I hope you guys are doing well today. I'm excited. Love doing the show with you each week. First of all, Josh, let's start with you. Your dad, Joe LaTour, he's off across the country, speaking,
across the world,
doing speaking and missions work. I admire Joe so much. He's halfway across the world right now. You were telling me, right?
Yeah. He's in Southeast Asia right now.
Wow.
They're in Malaysia. I think they have a few meetings this coming weekend, and so for him, it's actually it's in the middle of the night already.
Sure.
Tomorrow, basically.
We should give him a call live on the show. Yeah.
Right. Yeah.
Wake him up at like 3 a.m. his time.
He'd love it.
Put him live on the air. I'm sure he would love it. Yeah, I'm sure.
Maybe not.
Maybe not.
Yes,
Other
maybe.
than that, Josh, how have you been? So you guys are holding down the fort there. I know you've been busy.
Absolutely.
At LaTour Asset Management, haven't you?
We have been, Tony. Yeah, it's been good. It's been a good week. We've told you before, we have a suite at our local baseball field.
Yeah.
So tonight, my wife and I are going to host a game with, I think it's the final game of the season, or at least it's the final one that we're at, that we have the suite for.
Okay.
So we're going to be there tonight with some of our clients, and really looking forward to that.
Oh yeah, you're doing you're having a little get together with some of your clients, and
Exactly.
I think that's great. You're bringing them to the suite at the ball game. That's a fun venue, and that's neat that you've got a suite there.
Yeah, it's a lot of fun, and it's nice because if it gets too hot, which it seems to do here in Southwest Missouri, we can go into the air conditioning where all the food is, and that's kind of that's the way to go.
Nice. How about you, Jim? By the way, Jim, are you going to that event, or weren't you invited?
I'm not going. We take turns hosting events there, so I've hosted a couple other ones this year.
Okay.
I didn't invite him.
Yeah.
No, he didn't invite me.
Well, I know it's an exclusive list. I was trying to hint, and Josh basically got the nope.
No,
from Josh. No, you're not included. No, I'm just kidding.
It's a great way to show appreciation for our clients and get them out and enjoy some nice summer activity there at the ballpark.
Yeah, I think that's great. Well, hey, you've got a great show lined up for us today. Talking about habits that are attributed to those who have been able to accumulate wealth. The wealthy, they have certain habits that lead them to being able to save and make more money. And wouldn't it be nice if we can all do that? So we're going to learn from some of these habits. You're going to share the habits of the wealthy with us today so we can partake. I love that. That's going to be a good one. I've had a great week. I'll tell you, I went to the Monday Night Football game. You know, I'm from Minnesota, so I am a Vikings fan. And I do work with another financial advisor who lives in Illinois, is a huge Bears fan. So he invited my wife and I to go to the Monday Night Football game with him to see the Vikings play the Bears, the first game of the regular NFL season this year. Right. So I was there in Chicago Monday night. Great seats. He got us. I don't know how he paid for these. I wouldn't have paid for these seats because they're so expensive. But we were lower level, 50-yard line, about 19 rows up behind the visitor bench, the Vikings bench. And the first half of the game, I don't know if you guys saw it or if any of our listeners were watching, but the Vikings did horrible the first half. They looked terrible, and the Bears looked amazing. Second half, we came back, scored 3 touchdowns in the fourth quarter to win the game. Crazy. So afterwards, there's quite a few Vikings fans there with the Bears fan. It's in Chicago at Soldier Field, so there's a lot of Bears fans, but a number of Vikings fans. It's about a 5.5-hour drive from the Twin Cities to Chicago. So it's not that far. And we're walking out, and the way Soldier Field is set up, you have to walk through Grant Park, and everybody exits together. There's no parking right around there. So everybody's kind of headed the same way. So there are literally thousands of people walking together out, and it's dead quiet. Like, I mean, you hear a little bit of noise, but it's really quiet because the Bears fans just got blown out in the fourth quarter and thought they had the game won. The Vikings fans are in enemy territory. So we're all just, when you brush by a Vikings fan, they'd look over and smile and just fist bump. Got a lot of fist bumps, right? No big celebration, right? Out of respect. And the Bears fans were great. They weren't giving too hard of a time. And then all of a sudden, you got to walk through these tunnels underneath the highway to get out of there. And we're in this big long tunnel. It's quiet. And all of a sudden, I think a group of Bears fans started chanting, "Packers suck. Packers suck."
Oh, no.
And so, but that was great because it's the one thing the Bears and the Vikings fans could agree on, and it got everybody
common
There
ground.
you go.
Yeah, they found the common ground, which is, I think, is something we all need to do more of.
There you go. There you go.
And yeah, so
they ought to ask the Lions if the Packers suck.
yeah. I don't think they do this year. I think it's very inaccurate, but didn't mean to talk sports. I just got a kick out of that. My wife and I laughed because they found the common ground, and everybody, it was so loud in there. Everybody, thousands of people chanting.
There you go.
After a Bears Vikings game, what do they chant? That was funny.
That's the only common ground there is, really.
They're teasing the Packers, and I normally don't use that word, but they were just making fun of the Packers. So
there you go.
Mutual enemy, right? That's good. Yeah, we have to find the common ground, and I think that's a good lesson for all of us, right?
Absolutely.
Yes, it is.
So when are we going to start talking about habits for the wealthy? Where do you want to start with this topic, Jim?
Well, Tony, I think now would be a good time to start with that. So, here's the thing when it comes to the habits that we have in trying to accumulate, retirement savings, right? It's a good thing to develop a lot of habits that help us along the way. There are some, a lot of times people don't pay attention to their budget. They don't pay attention to the fact that they can save in the 401k. They don't pay attention to a lot of these things. And it's a good thing to develop a habit of paying attention to your finances and what you're doing with it. Yeah. I was talking with a client earlier today, and that we were talking about some different things that they've been exposed to because of they've been farmers. And they had a pretty large scale farm. So they paid attention to, specific sectors of the investment universe that most people don't. And they paid very good attention to it in a way that they were able to help themselves out greatly because of how much attention they did pay, right? So some of these habits here really just set us up for success. And a lot of these habits, if you put them to work for you, it's like success is almost automatic, right? Now you can't, life is going to happen. So we can't, it's not a guarantee, but, they do help us out greatly.
It sets you up in the best possible position.
Yes.
Yeah.
So we've got some habits here, and what our subject here for today is they're not just for the wealthy. They're really something that's for all of us.
Exactly. Yeah. And something I like to tell, we've got some younger neighbor kids around us, late teens, early 20s. Mm-hmm. And I encourage them, well, go ahead and start putting money away, not just because I think you're going to all of a sudden, grow this giant nest egg in the next couple of years, but you're going to start that habit. If you start, inching the right direction, it ends up catching up with you. Yeah. And the same thing happens if you go the wrong direction. So if you start getting yourself creeping into debt, and you start getting into that habit, that can snowball too and really affect you. So starting to form the right habits really do set you up. So let's talk about some of them, Tony. The first one is, paying yourself first. And it's something that's simple to say, but not always very simple to do.
Right.
So you want to treat your savings like it's a non-negotiable bill, not necessarily you spend through your paycheck, and then whatever's left over, it goes to savings. Well, if you plan what goes to savings first, and you get that taken care of first, then you can start spending what you need to, and then maybe add in some of the wants as well. So making sure that it's a priority and not just an afterthought, I think is important.
Yeah. Yeah, and that's true, and I've always heard that, pay yourself first,
Right.
but I always kinda wondered, what exactly does that mean? And that means, you don't take money out of your bank account and hand it to yourself, for people wondering what
Right,
that
right.
means. It means you put money away for your future before spending it on other things. That should be the first thing you do, is put money away in a 401k
Mhm.
or a other type of retirement account or long-term investments, right?
Yeah, absolutely. And I was going to add to this just a little bit because so many times we do talk about the 401k and the IRAs.
Hmm.
And if you have that available to you if you have that 401k available, absolutely. That is I tell people, for nearly 100% of people, that is a must do. Right. And, if you can get yourself, obviously start with at least enough to get the match. And we've said that before, and we're going to say it again along the way as you listen to us here. But if you can get yourself to some little bit higher contribution levels, you can work your way to them. So maybe this year you've been contributing 6 or 7%. Well, bump it up to 8. And then, a year later, look at it again, bump it up till 9, and, keep working away. If you can get more than 10 or maybe even as high as 20% that you're contributing to that 401k, you're going to set yourself up really, really well for your retirement years.
Yeah.
And now, another thing a little tip I wanted to put out here with related to this is that most people don't realize that you can split your paycheck. So it's not all just going to your checking account. So you can have a portion of it maybe go to a savings account right there. So it's not even in your checking account where you spend it. So setting something aside, for those semi-annual or annual expenses, that is a huge help.
Yeah, because even though you're expecting them, they still sneak up on you.
Always. They always come up.
Every year when I get my property taxes, I'm like, what?
Oh, yeah. We did know that was coming.
Yeah.
It's come every year for how many years, but right. They always come up that car insurance, right? If you pay it ahead or you pay annually or semi-annually on that, or life insurance. Some of these things, they'll give you a little bit of a discount if you pay, one payment for the year instead of monthly payments. Right. So if you save up that way, you're earning interest and you got a discount for making that annual payment.
Right. Now, speaking of earning interest,
Right.
something I've been asking a lot of my clients, because
Mhm.
a lot of times you don't necessarily need to have everything that you have invested. Not every dollar is meant to be invested. Some
Right.
of it just needs to be in the bank
Mhm.
and have that safety, the FDIC insurance. But even with that, it's important to make sure it's still working for you. And a
Yes.
lot of times, people they put it in their savings account that's earning nothing at their regular, state bank there on the corner, and they don't pay any attention to it. And they've got
Right.
$40,000-$50,000 sitting in an account making 0 point nothing for no reason.
Mhm.
So I tell my clients all the time, I think it's fine that you have money in the bank, but make sure that that's still working for you. And let's you shop around a little bit
Mhm.
and find a good high yield savings account where you can make in the range of 3 to 4%. I mean, that's just a no brainer. If you can continue making money on the money that you're setting aside for safety, because if it's not making anything, keep in mind inflation is still moving forward and it's
Right.
eating away at the purchasing power of that from the bottom. And so you want to make sure that it's earning more than what inflation is eating away at it, to at least keep up with that, and then maybe even make a little bit better.
Yeah.
A lot of people, don't even stop to think about some of these high yield savings accounts. And, they're not going to be your brick and mortar branches, right?
Yeah.
A lot of times these are online only banks. So, your cell phone or your computer, that is your branch to this bank. And so I highly recommend, do your own due diligence on the bank you're going to be using. There's some big names out there. There's a couple of them. I just put them out there. Credit Karma is a big one. They do a lot of other things. They have a lot of financial information as well. There's a couple of them that I've used, like Ally Bank, CIT Bank, a lot of these other ones out there. I know that even Chase has some high yield savings. So, but look at the terms, and you're going to have to read through the terms of the account and see, what is best for you. But by all means, put those funds, those savings to work for you.
Right.
Well, yeah, and you've got to do that. I've heard stories about people who have $250,000 in a checking account.
Yep.
Right.
That they don't need. And it's important to have an emergency fund, but at the same time, you might want to move some or a lot of that into some type of interest-bearing account that's going to make over 1%. You're losing money to inflation, obviously, if you do that. Yeah,
absolutely. Now, Tony, this next one, this is one that is definitely easier said than done, but I think it's still important, and it's just living below your means.
What? Come on, guys.
I know. I'm sorry.
You're not going to actually try to tell me I have to live below my means. I can't spend more than I make. Is that what
right? Exactly.
The U.S. government does that, though.
We just lost half our listeners at least. They're like, these guys, what do they want from me? Miracles?
Yeah, well, it's an easy thing to do. Start spending more than you're able to maintain.
Mm-hmm. Look at our government.
Exactly. Yeah, it's lifestyle creep is what you call it. You just maybe you're not all of a sudden just spending big purchases, but you're just over time just increasing what you're spending on things. And I'm definitely guilty of it myself. The number of streaming services and stuff that is out there to spend money on. There's so many. Everything is a subscription anymore.
Right.
And then every couple of months they seem to up it by $1 or $2. Sure. And before you know it, you're out several $100s a month just in subscription, some of which you forgot ever existed. And so making sure that the spending you're doing is intentional. I'll tell you, actually, Tony, I caught myself today. I had a subscription to a backpacking company that basically they took the subscription that you paid and they put it into store credit, and I could purchase their things from it. And I forgot about it. And it was $10 a month. It wasn't that big of a deal. I remembered it today. And I've stopped it. So
well, you might have a lot of money in there to spend, though.
I had some store credit. I'm going to use it.
Yeah.
Or I could help you use it.
Yeah, that's okay.
Hey, I'll volunteer my services there too if you need it. I mean,
I worked hard for that store credit. But just paying attention to what you're actually spending and actually having a knowledge about what you're spending. And I think that is why it is important to have a budget, because otherwise it's so easy just to get out of control because you don't know which direction you're going. So I think that's where a budget comes into play.
Yeah. Having a budget, people don't like that word, but you got to have a budget and stick to it. That's true. And that way you won't live, you'll be able to live below your means. You won't spend more than you make if you have a budget and stick to it. Right.
Mm-hmm. Yeah. Well, it's a spending plan. So you're basically like Josh, he used the words, spend intentionally. Mm-hmm. And so many times we spend so impulsively or passively, and, we're just go along with, whatever is in front of me at the moment, instead of, making a plan. This is how I'm going to spend my next paycheck. And this is how it's going to, maximize those dollars for myself. And, doing that really does, in the long term, it does help out greatly.
Yeah.
So
that's huge.
So one of the other ones here that we want to talk about is staying clear of costly debt.
Right.
And, you know what I'm talking about, those high interest credit cards, right?
Oh yeah.
Those things, it's so easy to use them. Just pull them out and you can spend, you can buy whatever you want that's in front of you. But the big thing is, can you pay that credit card off at the end of the month?
Right.
Because if you don't, you're going to be paying some pretty expensive interest. And if you bought something on sale and you can't pay it off, now that item is considerably more expensive because of that interest.
Right.
If you think about it, if you have a 24.99% credit interest rate on your credit card, you are essentially paying 25% more for everything you buy. Now, you and I wouldn't do that if we were looking at the same item. Okay, so in store A, it's $10, and store B is $12.50. I'm going to go to store A. I know it's going to be cheaper there. I'm going to buy it there. Right. But on our credit card, we end up paying that extra price on that because of that interest. So if you do find yourself in that costly credit card debt, we want to get that paid off as quickly as possible. And I want to talk real briefly. There's two main methods that people talk about how to pay off when you have multiple debts. How do we structure this? How do we order it so we can intentionally pay these things off instead of just winging it? So number one is that people talk about a big one that's out there is the debt snowball method. And that essentially means you're going to list, take a pad of paper, list all of your debts in order from largest to smallest. And you're going to pay the minimum payment on all of the debts except for the smallest one. And you're going to put as much as you can over that minimum payment onto every month until it's paid off. And then however much that dollar amount is, you're now going to add that to the payment on the next debt. And you're going to work your way up till you get to the larger and larger debts, and as you get them paid off. The debt snowball method works for, personally, I think it works for the majority of people because it gets you that psychological win, right? I see the smallest debt get paid off. Maybe it's paid off in 3, 4, or 5 months, something like that. And a few months after that, the next one gets paid off. And then, 4, 5, 6 months later, the next one's paid off.
Yep.
Whereas if you have some larger debts, but you have some pretty high interest debts as well, the other method is called the avalanche method. And that is where you list your debts in order from the highest interest rate to the lowest interest rate. And you're going to pay the minimum balance on all of them except for the one with the highest interest rate. Now, the only issue with that I find is you have to be extremely disciplined over time because a lot of times that one with the highest interest rate is not necessarily your smallest debt. So it might be a little while before you get to the next debt to start working on the next one. So if you're that type of personality where once you start something, you're locked in, you're not going to change, you're just going to keep plugging away at it, it can work for you. And the avalanche method when you look at the numbers, will get you paid off a little bit faster, but it doesn't get you the psychological wins along the way that the snowball method does.
Yeah.
So when it comes to paying off debt, highly recommend figure out what order you want to list them in and put all of your extra funds on just one and make a minimum payment on all the rest of them. That way you get them knocked out one at a time, and it really does help you out.
Yeah. Yeah. Getting especially those high interest cards and debts, got to get those paid off. You can get in a hole really, really fast and not be able to dig yourself out. So I think that's great advice.
Yeah, absolutely. And I think the next habit to build is planning aggressively for your future. And I think really bringing a financial services professional into that planning process is important because one, they're going to help you stay on track. They're going to give you some guidelines to follow when you're doing this because, well, they've watched other people be there before. They've helped other people through this. They can help you as well. And so they can give you a plan. I think that's what people oftentimes are missing is a plan for the future. And so they look at retirement as a big, scary thing because they don't understand it and because they don't have a plan for it. Well, if you don't have a plan for it, then it will be scary. But if you get something, put down on paper with your financial services professional, and it's something that's able to be understood, man, that can bring so much peace to this new chapter of life that you're approaching. And so starting early, I think, is important. And that was why I mentioned, even in your, late teens, early 20s, starting to put money away and starting to work with a financial service professional could be so important because you're going to be setting yourself up for 20, 30, 40 years down the line. And once you get to that point, you're going to be so glad that you were paying attention in the early years.
Yeah.
Well, as I always say, save early, save often, right?
Exactly.
Yep. Just like vote early, vote often.
Yep. I love it.
So the next one I want to talk about here is to prioritize your assets over liabilities. So when we think about investing in maybe dividend producing stocks, something that is going to give you something that not just the appreciation, but also those dividend stocks, they're going to give you that dividend that's going to be coming in on a quarterly basis. Maybe one of look at something like real estate. A lot of people can do this one. You do have to do your own due diligence in the real estate, and there's a little bit of a learning curve. But investing in real estate now, I'm not talking about your home, because your home is not something that you're going to use to sell and live off the funds from that in the future. You're going to need to find another home to live in if you sell yours. So we're talking about investment properties. For many people, real estate is an additional asset that works very well for them. So look at your investments, get some funds into something that's going to appreciate for you and work for you, not just something that you're going to buy. And if you wanted to sell it, well, now we know you have to take a loss on it. That car that I buy, that brand new car, well, I drive it off the lot. Well, I just lost at least $1,000 on it, and give it 3 years and I've lost at least 25% of the value. No, I'm looking for something that when I buy it is going to increase in value into the future. So when I sell it, I made a profit.
I want to go into one more. I know we're getting close on time here, but it's just getting yourself educated.
Right.
And I think it's so important to be financially savvy. You may not be an expert in the field, but having some savvy in the financial realm is important. And what it can allow you to do, Tony, is you can have more educated risk. Because I've seen people, even younger people, who are so scared of the stock market because they don't understand any of it. And they haven't taken any time to be able to help themselves understand it. And so the smart investors, they have risk in their portfolios, but they're diversified. And so they've got risk that's spread out across the gamut of investments that's out there. And that helps lessen that overall risk, but it still gives them good upside potential. So I think, first off, getting yourself educated can help. Ask questions, talk to your financial services professional, and make sure that you can understand a bit about what you're doing.
Yeah, I think that's huge. Well, great show today. And before we go, let our listeners know how they can get a hold of you.
So you can give us a call. Our phone number is 417-641-3497. Also, visit our website at LaTourAsset.com. We have a lot of information on there for you.
All right. Great show. Again, that's LaTourAsset.com. Check it out. Set up a no-charge, no-obligation consultation with the guys and the team there at LaTour. And thanks for tuning in. That does it for today's episode of LaTour Retirement Talk.